All right, guys, welcome back. Episode 5 of the Crypto Alpha podcast. Feels like we've really got it all figured out now. We've got the audio flowing. The podcast is pretty much everywhere anyone wants to subscribe or download a podcast, whether it's Apple, Google, etc. We now have the first 4 episodes up on YouTube. So if your preferred platform is video and YouTube, it's all there as well. So I'm excited for this version of the podcast, or this new episode, because we're going to dive into an area that's starting to become, the talk of the land. We've had all this chaos in crypto, and it seems to continually cascade into lower lows and additional contagion and liquidations. And I think that drama and soap opera is going to continue in terms of the actual liquidity in the markets. But what's also happening is now you have the knock-on effect that plays into things like the mining. And we can't understate the fact that Bitcoin is a network, and the network needs to be supported. But at a certain point, maybe it's no longer profitable for some of those participants. And so, Brandon being our resident hardware techie, it's going to be fun to have your input and feedback and thoughts on what's happening in the hardware and mining world. Before we jump into that and hand the mic off, Andrew, do you want to hop on here and kind of give some thoughts on what's been going on, at least since the beginning of the podcast up to now, or even just since last episode?
Yeah, I'll say since we last spoke, we've seen a bit of a price recovery across a lot of the cryptos, and additionally, Solana decoupled a little bit from the Bitcoin and ETH core indicators. However, I think this is kind of a bit of a dead cat bounce, just seeing as nothing has really changed in the macro sense. And I think it's hopium that people are buying back up on, but I think we have a lot more time in these lows, and I think it's going to be going lower from here. So for me, I'm just going to be patient. I'm not going to be trying to catch bottoms here, risk catching a falling knife, stick with what I got, and just bide my time is my strategy from here on.
Yeah, it feels like that sentiment is kind of starting to permeate everywhere, which is a little bit of how you lead into that next crash, because there's none of that support liquidity, and people are kind of nervous and sitting on their hands. But at the same time, that's also when you start to see bottoms, because everybody starts to take on the same consensus opinion, like that more pain is going to come. But I would agree. I think this is kind of a pause before the next slide. Sailor and MicroStrategy would clearly disagree with you, as they just bought more Bitcoin. So we'll see what happens. But speaking of Bitcoin, Brandon, you want to jump in here and start educating all of us on the world of mining?
Absolutely. Thanks to both of you. I look at things like the situation we're in now is the newly interested participants that got in because they, bought on Robinhood or Coinbase. Um, a lot of them have been chased off, but there's a great number of people that have decided to stick around. And those people that have decided to stick around are now starting to dig in. So as opposed to at one time just going and buying whatever thing they heard, they saw, they had a friend tell them about, they're starting to look at what the things are that they were buying, and sadly maybe buying at the top. So we've got a lot of people that are unaware of some of the nuance and what's going on in the background. They may know that this is mine, or this is a stake, or this is a yield, but once you get into mining, you can get a lot more data about the underlying network, and you gain the ability to see um, what the network has the potential to do, or what the network has the potential not to do. And it's going to be a very valuable tool in deciding what you want to jump into, when you want to say, hey, now is the time that I want to start doing X, Y, or Z with this. So, we've got a lot of people that are now looking for that data. Um, there's a lot of proof of work coins out there. And I think I'm going to focus today just really talking about Bitcoin, because as the first widely accepted proof of work, um, and the way that it was built on other things for 20 years, It's really the I'd hate to say the gold standard, but when you think about mining, Bitcoin really is the gold standard, and everything else has just tried to come along and put their own spin on it. So, um, going into that, uh, what I want to lay out is what the foundation was, what it's set to do, so that when you look at Bitcoin or any other coin in the future that is proof of work, you know what things you want to be looking at and taking data from. Um, so, without going into a history lesson, I want to go over some of those frameworks and what's going on.
All right, before you
Just a
get
quick
started on
question.
that, go ahead, Andrew. Go ahead.
Oh, I was going to ask you for those in the audience who maybe aren't as familiar with blockchain infrastructures, could you maybe give us a quick description or explanation on what proof of work means?
Yeah, so proof of work is the process in which calculations are performed to achieve completion of a block, which then gives the person that gets that block's answer or solution and provides it into the network, then they get a reward for that. And those are the steps that chain each block together over time that build the blockchain and keep it running and moving. So with Bitcoin, um, the framework, for that was how long the block is going to take, so the block time, what the calculations were, and the structure in which they're emitted. So, you have a set number of coins, and they're going to be processed at a set number of rewards per block, and over time, the block reward will diminish in regards to Bitcoin, and you'll get less coins per block based on the fact that the presumption is more people will come along and jump on and continue mining, making it more scarce.
Okay, so a couple things I want to, Andrew. That was one of the questions I was going to present here early on. So thanks for that. The other thing I want to back up on a little bit is one of the points you made, which I think is really valuable, is there's this phase that people are going through that maybe they got in early and didn't sell, maybe they got in late and they're sitting on something that is painful to look at from a price standpoint, but it's causing them to at least question what they bought and learn more about it, which it's kind of the process of failure. You can take a failure for failure's sake and not learn from it, or you can learn from it. And if you bought something at the top and it's now worth 70% less, well, that's, I guess you could say, an investing failure. And there's a lot to learn from that. And for us having these conversations, doing these podcasts, particularly at a time that, it feels like we're entering a crypto winter or a bear market, this is really the time where you should be diving in and learning, because then when the opportunities come along, you've, number one, learned from those mistakes if you were a victim of them in this last cycle. And even if you aren't, you don't have the pressure of trying to chase price as it's going parabolic. You can take the time to dive deeper and look under the hood and understand some of this. So when there is a bull market going on and there is a tailwind and the opportunities are clearly existing, you can be more pragmatic about how you approach it and not be so emotional. So going to what you were talking about just a moment ago in regards to proof of work, I'd like to, at least before you get any more technical, dumb that down a little bit more and say, if you were Satoshi Nakamoto today and you were going to mine the first Bitcoin and any number of Bitcoin after that before, say, another computer joined the network, what are you actually doing? Like, what's the Bitcoin protocol requiring you to do, and how are you rewarded for that?
Okay, well, in simple terms, what you're doing is you're using your hardware. Early on, it was just a CPU in your basic desktop computer, and you're performing calculations, which is essentially the root of what every computer does. So your computer is going to sit there and process a mathematical equation, and it's going to hash out what that block is. So once it completes that, it's going to submit that block to the network, and then the network is going to propagate that block across the rest of the network as the valid block, and then a new calculation is going to appear, and everyone starts over again. So if you didn't get it in Bitcoin's case, that 10-minute period you ran for 10 minutes, you're not going to get a reward for that 10 minutes you ran because you weren't the one to submit the block. But you start back at zero along with everybody else on the network, and you're going to try for the next 10 minutes to submit the correct block hash to the network, and the network's going to say, hey, you got it. Now you are going to receive a subsidy or a block reward, and you're also going to receive your share of the transaction fees that were the transactions that you included into that block.
So you have a protocol, you have software, basically, that you're running Bitcoin, to intentionally quote the infamous tweet by Hal Finney. And by doing that, your computer is trying to solve these mathematical equations. Is that what you're referring to as sending hash to the network?
Yes, the more power you have, the stronger the processing unit, the faster you can run through all the pure permutations of what that hash is going to be the one to get it. So if everybody is running their desktop computers and you have a server, you essentially have a bunch more desktop computers, and your processing capability is going to be increased over the average person running their desktop computer, and you're more likely to get that block. And that's really how everything started out in the beginning. Is you had a bunch of people with their desktop computer or their laptop, and it was just running this program in the background, and there wasn't a lot of challenge to get those early blocks. As more people came along, they increased their hash power, which increased the uh, potential for those with more hash power to get the blocks, but it also decreased the people with lower hash power and their potential, which created essentially an arms race. And you have people trying to come up with newer, faster CPUs or servers. Then it went to GPUs, and eventually we got to the point that we're at now, and has been, historically for quite some time. Uh, ASICs, which are application-specific integrated circuits, which are big computational devices that only do Bitcoin transactions or hashing for whatever network you're speaking of. So the guy with his desktop computer might run for 400 years and never get a block, because there's these people that have essentially that focused power of maybe 10,000 desktop computers in one box. So that's how we've taken the network away from, over time, it's evolved from an individual person to a larger device, to now we have pools and mining facilities with huge spreads of machines running very large amounts of hash power to get that next block in the 10-minute period.
That was a great explanation of ASICs and how they've kind of come to be as this dominant computational force. The intense hash power from these machines that are designed to do only one thing, and it's to run that SHA-256 Bitcoin algorithm. You can't do anything else with these things except use them as a doorstop. If their hash power is no longer competitive, in a fastly growing, fastly evolving computer network. And so when as this network is growing and you have these block rewards happening, and ultimately you have this in the cloud network that is saving these blocks of data, and you can save data on these network blocks. You end up creating this immutable chain. It can't be undone. You can't go backwards. And it's supported by a decentralized network of these machines. So that's another big part that it would be interesting for you to go into, because that's certainly one of the core strengths of Bitcoin, and at the ethos of this decentralized cryptocurrency ideology is that you have no central point of failure. Certainly, there's a bit more centralization happening as you get these giant mining facilities where all these miners are in one place, and somebody could, take down that mining facility and you lose a lot of that hash power. But there's people mining from all over the world in all different locations, and they're all verifying this data somewhat simultaneously. So there's really no point of failure that you can go after to disrupt the network. And therefore, you kind of create this decentralized community that's supporting all of this stuff that's going on. So I don't know if you want to kind of take that baton and talk about that a little bit more, or if there's a topic that previously you wanted to go with.
Touching on what you just said, yes, those machines are doing those calculations, but what those machines are not doing is they're not storing the data. An ASIC doesn't have a hard drive on it like your personal computer. So back in the day, as we'll call it, when you were running your CPU and you were mining, you were saving the blockchain to your computer as well. So you were doing two unique portions of the process. You were both processing data and saving data that you were then serving up in a decentralized manner to all of the other nodes. As we got to these ASICs, like I said, they don't have hard drives in them, so they're not nodes. They're just providing hash power. So any centralized context is going to be that those hosting the nodes are the weak points. Most of the larger mining farms, they both run nodes and provide hash power. So it's very important that we may not be able to decentralize hash power because there are large entities out there at this point running huge amounts of these ASICs. We all can run our own node. And running your own node is creating more locations that this decentralized data and that this blockchain will exist on and be served out to people. So it's important that while you may not be able to run hash power, whether it be because of the cost of the machine, or it be the cost of the power where you're at, or the lack of power, it's not as costly to run a node and participate in the network and provide essentially a decentralized backup of the network's files as they exist, and provide a full copy of the blockchain to more people in other locations. So that's important to keep in mind. What's interesting is the the hash rate increases. Um, you have this guy that we call Satoshi Nakamoto. Who knows? Today isn't the day to really decide: is it one person? Is it an entity? Is it a group of people? Is this guy still around? Is this girl still around? Who they are at this point? They're just the creator of a series of different ideas that were all rolled together in a piece of software that created a network. So there were a lot of unique pieces that had to come together to bring this software, the cryptography of the concept, and the economics of what we have. So back in the 80s, we had an idea of a thing called e-cash. Then we had later in the 90s a thing called B money, and a thing called BitGold. Those are all things that came along and provided to the framework of the concepts that made this. And then we even had RPow, which was a proof of work that was created by Hal Finney, as you brought up earlier. All of these things fed into this new idea, which became Bitcoin, and used Hashcash, which was an idea of how to hash these things together to create this. Now, all of those things did not come up with the the economics of what and how Bitcoin was going to work. And with Bitcoin, you've got uh, a locked set. This is it. This is the maximum number of coins that this network will produce over time, and that's 21 million. And so, as you get exposed to the Bitcoin ecosystem, you'll see people talking about the number 21 million, and that whole benefit of that was Satoshi had realized they can increase dollars or rubles or euros into infinity. And they're always going to keep spitting out more, inflating the supply. With Bitcoin, there's a locked number, and that was one of those decisions in the economics of how Bitcoin would work. Um, Going from that, the decision had to be made of how would we get to that 21 million. And what was interesting is this concept of halving, that there would be a set period of time that these block rewards we spoke about would be a number, and then after that period they would go into the next period and it would be 50% less. So we started with 50 Bitcoin per block, then we got to 25, then we got to 12 and a half, then next is 6 and a quarter, and then just over 3. That process is going to run out for a, over a century. The focus, the goal, the end point is the year 2140, when we're essentially mining dust per block. After 2140, the only reward on the network is going to be the transactions. So into the future, Bitcoin doesn't stop at 2140. Bitcoin just goes to a transaction fee only reward. So you're not going to be getting a block subsidy. And the purpose of that was to reward the early miners for putting their hash power on the network and supporting the process. So one day, our great grandkids are going to be potentially mining with their dishwasher or their portable nuclear generator in their garage, or whatever the situation may be, and they're just going to essentially be like Visa, and they're going to be taking their share of the transaction fee, and they're not going to be rewarded for it. And the presumption is that Bitcoin will have such a value by that point that those transaction fees will be more than enough to provide support to the network.
Got it, man. Good. 25 minutes in, I would say it's a good start, and we have a lot further to go. So continue.
Well, like I said, with the hash rate increasing, with the ASICs coming on, and maybe in the future, there's who knows what kind of depth of technological advancements that we may have that come along. But for this entire period of time and into perpetuity, a Bitcoin block is going to be 10 minutes. And so every 10 minutes, a block should be made. Like you had brought up earlier, if there's a situation that takes miners off the network and we stray from that 10 minutes because there's not enough hash power, there's a system of retargeting the difficulty, which will bring that back into alignment with the calculation. And what's interesting about that is Satoshi figured if there's a change in hash power, in 2 weeks, which is a good enough amount of period to adjust because it is a long-term change and not a momentary. You don't want to be retargeting because there was a power outage in some country. You want to be retargeting because an entire region is no longer participating. So every 2 weeks, the difficulty can readjust, which will allow it to realign back to that average of 10-minute blocks. And those fluctuations do happen. But what's important is being able to watch that and be able to take reference point about the network based on what hash rate is doing. If you see a lot of miners come off the network, it may be because things are unprofitable for them. It could be because of geopolitical strife. Uh, it could be because any number of things. They just got bored. But if you have that kind of hash rate decrease, you can estimate and kind of see what the network's doing to determine if it's a good time to start mining or if this is going to be a reasonable time to stop mining. So being able to see these fundamental situations, whether it be the rewards that are going out over time, the hash power that is on the network, the amount of transactions on the network, understanding what's going on with mining plays an effect on everybody that may never mine. So if you're not a miner, you still want to understand what these actions are doing because they portend where the network is going over the short time as well as over a longer term. So it's important to understand these concepts so that you can protect yourself um, and maybe make your decisions on how you feel the investability or the participation or the hey, I need to buy these miners that these people are deciding are worthless. And now is the time for me to be mining these coins that they don't value because it's going to be the opposite of this at a future time. Those are all decisions that you make based on this information and seeing and deciding whether or not you want to be a miner or if you don't want to be a miner.
So this is, I think, a great overview / description of the framework of what's going on with the Bitcoin network, what proof of work actually is, like Andrew asked, the component of what mining does to the actual ecosystem overall. I'm trying to think of a good analogy, and you're certainly the king of analogies. So maybe you can fill in the gaps on the one I'm thinking, but it's kind of like, when you're looking at what's happening with price, and certainly it's been a very drastic drop in price. It's like the power company deciding to stop making power because a lot of customers decide that, it's too expensive to keep their lights on. And you start to kind of have a knock-on effect where it's this self-fulfilling feedback loop. Then more people stop, keeping their power on. The power company decides to shut down more generators. And at a certain point, do we reach equilibrium? Or at what point do you start to get nervous that, the network is no longer going to be able to sustain itself? And those are some of the things that, now that you kind of have this laid out, this framework, and by all means, rework that analogy. But how does this now, where do we go next? How is this now impacting, we'll say, the business of mining, if that's where you want to take this next?
Yeah, that's a good way to put it. I don't know if I have an analogy off the top of my head, but I'm sure one will pop up as we're rolling through this. Like you said, people decide to shut their lights off. It's the same thing with these Bitcoin or with a proof of work network. Now, you would stop turning on your lights if it wasn't a benefit to see what you were cooking based on how much you were paying to see to cook at night. So in that kind of concept, uh, you're going to have people that bought equipment that are mining. And if, like, for example, places, residential retail people in Europe, they may be spending 33 to 35 cents a kilowatt hour for their electricity so that they can run their miners. Um, these newer generation miners, I did a calculation earlier today. If you're paying 12 cents a kilowatt hour, which is the United States average rate for residential electricity, you're running your miner and you're getting about 20 cents a day in Bitcoin. So we're at a point where the residential people in Europe are definitely priced out of the value, and they're, like you said, turning off their lights. Your average person in the United States is probably turning off their lights, but there are people that are mining that are doing this at 2, 1.8, 3, 4 cents. Those people are profitable to the point that it's still valuable for them to mine and turn around and sell their Bitcoin to be profitable. So we get to a point where if it isn't profitable for someone, let's say 2 cents, if it's not profitable for a person paying 2 cents a kilowatt hour to turn off their equipment, we're going to see a huge situation. Now, that guy is probably making $8 a day off of one ASIC at 2 cents a kilowatt hour. So as long as they're profitable, the price is going to stay where it's at. If we get to the point where they're not even profitable, we're going to see a mad dash for the door. We're going to see a decrease in hash power. We're going to see networks come down all across the world. And we're going to see the price crater of Bitcoin because it's not valuable on the market. And if the prices of power don't change, but the price of Bitcoin changes to where, say, we're at roughly 20,000 right now. If we go to $10,000 per Bitcoin, that guy even making 2 cents or paying 2 cents an hour for his electricity, 2 cents a kilowatt hour, he's gone from making roughly $8 to roughly making $4. So at that point, they may take some of their machines off. If they take their machines off, the network slows down. There's people that are seeing that their Bitcoin is worth less and they sell out at the price that we're at now. All of a sudden, you've got people running for the doors trying to lock in whatever value they have left. Now, the big, larger entities, they were prepared, they were selling higher, and they don't mind scooping up distressed assets, whether it be Bitcoins or it be hardware or facilities. And once we get to a point where there aren't people panicking to sell their Bitcoin and panicking to sell their equipment, as simple as it is to say, that's kind of when we hit a bottom. So there will be a point where that happens, and I don't think it's yet. I think that there's so many variables that are going on that would cause people to continue to sell into comfort. And usually you get things like China banning Bitcoin, Russia taking crypto mining facilities. That's an interesting topic that we'll move on to in a second. Mining pools and hosting services and how that works. But just as not your keys, not your coins is a very popular conversation in cryptocurrency, I would say that not your rig in possession, not your hash power. So it's interesting to see all of these variables that have popped up and kind of distributed the support of the network from when it was, just 100 computers at one time on people's desks, humming away around the world, getting huge amount of rewards. Now we're at a place where there's any number of these variables that can affect the value now that there is a value.
So before, because I want you to develop this, not your miner, not your hash power type of idea. But before we start going down that path and looking at what's happening in the economy of Bitcoin mining, Andrew, do you want to come in here and perhaps share a question or share some thoughts on where the conversation has gone so far?
I would just say that maybe we could touch on the influence that governments can have over large swaths that you were touching on a little bit with China basically banning Bitcoin mining and Russia taking over. What influence that can have on the medium and short term on the hash power of the network. And when we saw China go offline, how significantly that impacted the hash power on the network for the long term. Do you want to maybe touch on that briefly?
And with that being said, Andrew and Brandon, the comment you made, this not your hardware, not your hash, the idea of what a mining pool actually is, like how does it get to a point where you have this deep centralization of hardware, and then along with that, Andrew's question about how governments can, through swift decision making, cause an impact to hash rate.
Excellent. So, in regards to hash rate, uh, any number of things can happen, and what we've seen recently is uh, it seems like it's a common occurrence. It's kind of become a meme in and of itself that China banned Bitcoin again. And so, this most recent situation was uh, whether it was due to a financial desire or manipulation of the market, or if it was just the fact that there's too many people there that need electricity, and they were providing huge amounts of hydroelectric power for very cheap prices, which caused a centralization of mining in China. Um, they decided to say that mining was not going to be legal. So them banning mining to take back that electricity that they felt was being utilized in the wrong way and to provide it to their people caused uh, a flight of hash power. So we've seen uh, large, massive, huge. I can't even find a word big enough to describe the amount of miners. But we saw 747s that had no seats in them, that were stacked floor to ceiling with ASICs that were being shipped from China to the United States because we were allowing mining in the United States just so that those people could continue mining. And part of the reason that mining was so big in China at that point was uh, every manufacturer of these ASICs is pretty much in China. So having the cheap power and having the majority of miners meant there was an imbalance of power for China to control the narrative of Bitcoin. Um, and what we touched on there in your questions were pools. And what pools are is, as I said, we went from using your desktop computer to running a number of these ASICs to eventually we got to the point where we had massive entities pooling hash power both in a centralized location like China or providing a mining pool which allowed miners from around the world to submit their share of hash power to a collective group or a mining pool to allow them the best potential to get the most amount of blocks. So you could participate with these Chinese mining entities and you could add your 10 machines in your garden shed in Oklahoma into the network and pool with all of these big miners in China to take uh, a majority share of the greater hash power, meaning you're more likely to get rewards with them than you are mining by yourself. And what's interesting is some people decided that we can run a pool, but we would be better off if we were providing services. And so the services they provided was co-location or hosting. So you have these hosting entities um, that are selling the miners, they're providing the hosting, they're subsidizing or invoicing those consumers with those smaller number of units, uh, providing them electricity and infrastructure, internet connection, uh, maintenance, repair. So they become one stop shops that you take your money or your Bitcoin and you provide it to them, and they provide you more Bitcoin essentially. Um, so uh, I don't know. I don't know if you guys are ready for me to go into a specific about the not your location, not your rigs kind of situation. Um, but where I'm moving to with this is the recent situation with a company called Compass Mining.
Yeah, I think it's a good time to jump into that. The one last, or the thing I'll say to what you just last said is, it's a little bit, so to make it clear as to what you were just describing. So you can pull the hash rate where you're sending your hash power to a kind of a network location where all of that power and that energy is being consolidated to use on the network to try to win those rewards. But you can also then, take it one step further where it's kind of an overall all in-house service where the miners are hosted there in the same physical location. And in essence, one would think like, hey, well, I'm giving you my miner to be part of this co-location for cheap power, because that's probably why the location physically is where it is. And we're going to participate in this pool in this centralized location. But in some cases, you just start out paying into that co-location, right? I don't have any miners. There's this company that's doing this service and this offering. You can send them money and say, hey, I'm going to buy a miner from you, but you're going to do everything else. And technically under that agreement, you have a miner somewhere in that facility, but all you're really doing is funding this overall business and the growth of that business for cash flow. So it's a little bit almost like a crowdfunding deal. You have all these people coming in and throwing a little bit of money to participate in this network opportunity, which is we're running hardware at a cheap cost for electricity, because we have all this equipment in one place and we're operating as this cohesive, powerful hashing unit. We're going to potentially generate or win more rewards and generate more cash flow. And depending on your size of participation, whether it's a number of miners or how much cash you put in to own miners in that facility, you're going to get a higher return. So it's really a cash flow model type of business. And so if I have any of that wrong, but all of that, let me know if I have any of that wrong, but all of that starts to kind of crumble and fall apart when electricity goes up or the price of Bitcoin goes down or hash rate difficulty goes up and you start winning less. So certainly go into where this is starting to happen. I mean, we're having all of these financially driven or financial derivative type of businesses implode. First, it starts with Terra Luna and the stable coins. Then you have a trickle down effect, and you have the Celsius, seizing assets and freezing withdrawals, and you have 3 Arrows Capital blowing up, and you have all these counterparty things, which we talked about last week. Now it's trickling into the infrastructure that makes these networks even operate.
One thing I'd like to add is you can think about a mining pool, sort of like an office lottery pact, where everyone buys a lottery ticket, and if one of them wins, the whole office splits the prize. And the centralized mining operation, where you're delegating your miners or just your money to be totally operated by a separate centralized entity, is more like buying into a co-op with an elected board of directors. Would you agree with that, Brandon?
Yeah, that's an excellent way to put it. Um, the the benefit of these location facilities is you're also entrusting their track record and their capabilities to continue to grow, as opposed to it being more lottery based. When you find a good facility, because um, you can't profitably run your equipment yourself, you are entrusting their business chops as well, and their ability to run this entity and continue to grow this entity so that you can compound your returns. So maybe you step into the facility with one miner, you mine for X amount of time, and then you take those profits, and now you're running two miners with them. Those two miners allow you to run four, those four allow you to run eight, and eventually you've grown to be, a big participant in this entity. But when things, like John brought up, all of these dominoes that have fallen, they all collapse. Now, instead of you running a profitable situation, your electric bill, because now you have 200 machines at this facility, is more than your returns in a month, because of the decrease in the base asset or Bitcoin. Now it's not worth enough for you to be running these machines. Now you've gone to a point where they're going to offer to buy back these machines from you at current market value, uh, and it's gonna hurt your bottom line. You're gonna have to start all over again, and they may be able to turn around, run them for themselves, or turn around and sell them to someone else and become profitable again. So it's concerning that you can play for too long and get yourself too exposed to what the larger market or these smaller individual companies have caused and done. And that's what leads me to, um, like you said, John. We've talked about Three Arrows. We've talked about Celsius. We've talked about Luna in previous podcasts, and their effects. Um, Affected themselves, affected the price of the overall base asset. So now you've got groups like Compass Mining, which is, I wouldn't say blowing up right now, but geopolitically, they had a huge contract and a huge number of their units of equipment in Russia. Russia took all of those machines and has nationalized the Gazprom uh, power production that was running those machines. And now there's $30 million worth of Bitcoin miners that are now mining for Russia. That everybody that owned them there, whether they had a contract for a year, 5 years, whether they were intending to pick their machine up and have it shipped back to them, uh, they've now been claimed. And so they're never getting those back. So that's when I say not your location, not your rigs, is much like not your keys, not your coins. Because if you can't go and unplug it, pick it up, and throw it in your trunk, is it really your miner? Is it really your ASIC? And people are going through that lesson right now.
Yeah, the point that I really want to highlight here, which we've talked about in a previous podcast, I actually think it was last week, which is, who is the leadership? You are, as much as people want to bang the decentralized drum and talk about the future of finance and all these other exciting potentialities, the reality is you're investing in a business, a very volatile industry, and a lot of unknowns exist in some of these investments that people are making. But when you start getting into it's one thing when it's a digital token existing in in fairy tale land, but it's very, very different when you start talking about real life hardware, locations, a retail facility, power, the cost of power, getting access to that power, and probably one of the most important things anytime you're thinking about establishing a business or making a big real world investment, which is we all know the saying in real estate, which is location, 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 but you have political, geopolitical, and generally speaking, geographical risk when you're dealing with real life businesses. And, it's always hindsight 2020. We're not trying to grave dance on anybody who's now taking some of these hard lessons, but Russia, come on, your equipment's in Russia, and that wasn't treated clearly with the appropriate geographical and geopolitical risks that have now led to people losing their equipment.
Yeah, I think the important thing to take away from this that wasn't taken away this time, and obviously wasn't taken away in past times, is um, if you really believe in the network, if you really support it, you should be running a node. And furthermore, you should be running a miner in your own garage. Even if it's costing more than it's making at this current moment, if you're not running that piece of equipment yourself, um, you're allowing a lot of entities that would fall under the too big to fail, but they're not too big to fail concept. So you've got all of these failure points that you're allowing to occur because of short-term profits as opposed to long-term support. So if you want to participate in the network, um, running your own equipment, even if it was all the people that are into Bitcoin were running one ASIC, that would make a much larger change to the ability for these entities to bring things down. I think in the future we will see more people running their own and participating, as opposed to letting someone else do it for them. And I think that learning about crypto because banking failed you, I think learning about mining because crypto failed you is the next step that people need to make. Whether it be trusting your funds to Celsius or a centralized DeFi, CeFi platform to get a return. I think those easy uh, peanut butter and jelly, uh, soft, chewy food kind of concepts are why we're where we're at right now. And people are going to need to, take a little bit more time and chew on what they're eating and know the food that they're consuming or know the network that they're participating in. And that's going to benefit everyone in the long run because uh, that simple participation is what put us where we're at right now, where Bitcoin, for example, dropped from 69,000 to just over $20,000 right now. So I think the bite that you take, that you chew, I think everybody needs to be a little bit more mindful of what it is they're biting, what they're chewing, and chew on it for a little bit longer, because it's not something you just swallow. And I don't know if that's a silly analogy, but we all need to participate more than just getting a yield if we do believe in what it is that we're doing here.
Well, speaking of chewing, I think we did a pretty good job, or I should say, you did a pretty good job of grinding through a pretty dense topic in under an hour, kind of taking us on a journey as to really what's behind the idea of proof of work, using Bitcoin as the core example, and applying it to all the elements that have been going on over the majority of this year, from the price action to a lot of the hard lessons that people are learning, and the value that we can take away from those lessons so that the network's stronger longer term, and we're making more sound investments going forward. So great job, Brandon, on that. And we're coming up now just short of the hour mark, so I think it's a great time to wrap up this conversation. Andrew, did you want to add anything else?
I'll just say that I think that went really well. I think we covered a very complex topic and was able to hit a lot of key points in less than an hour. So I think for those interested in learning more about mining and understanding the basics of Bitcoin mining and why people mine Bitcoin, I think this is going to be a great resource for them.
I would agree, Andrew. Thanks, Brandon, for that. Clearly we both appreciate your insights on the topic.
Thank you so much for giving me a chance to babble incoherently and make bad analogies. I really enjoy doing so.
Well, good stuff on that. Episode 5 feels like it's a wrap. Guys, I look forward to chatting with you next week. Until then, good luck out there in the crypto world. If it's not your hardware, not your hash, if it's not your keys, not your coins, protect yourself, learn from some of the mistakes you're making, and continue on this crypto journey with us in the next episode. Thank you all very, very much.